Hey everyone, I hope you had a fantastic Thanksgiving holiday. And as the end of the year approaches, I'm going to focus the upcoming videos on the 2026 investment outlook for the four main property types, starting with office. Now, as everybody's very well aware, office property performance was severely impacted by the pandemic, and it has been struggling to recover ever since. But momentum has been building. Office space absorption has been positive for 6 consecutive quarters, and while there's still a long ways to go, the combined space demand over the last year and a half has totaled more than 127 million square feet. That has brought the national average office vacancy rate down from a peak of 17.2% in early 2024 to 16.4% as of the third quarter of 2025. But the space demand hasn't been evenly distributed. Tenants have generally favored newer, smaller, suburban office properties. But at the same time, we're also seeing strong demand for top-tier, highly amenitized Class A office buildings in select markets like New York City, Washington, D.C., Miami, and Dallas. Major markets sustaining the lowest vacancy rates include Riverside, San Bernardino, Charleston, Miami, Cleveland, and Tampa, but there are also a variety of smaller tertiary markets that are outperforming, including Knoxville, Tennessee, Madison, Wisconsin, and Reno, Nevada. In general, since the end of the pandemic, there has been a slow but steady return to the office, with hybrid schedules being dominant. Compared to pre-pandemic levels in 2019, office space utilization fell by more than 90% during the health crisis. By early 2023, utilization was back up to about 50% of pre-pandemic levels, and as of October this year, utilization was about 70% of 2019 levels. And it looks like the trend will continue, with utilization slowly rising in 2026. But the trend could potentially get a boost from a modest rise in the unemployment rate. Many companies, especially in the financial services and tech sectors, have been trying to bring more employees back into the office over the last few years. But the tight labor market has restrained these efforts. Companies have been reluctant to mandate return-to-office policies because of the shortage of workers. If job creation slows in 2026 as expected, and the unemployment rate nudges higher, employees may begin to work from the office more frequently, in turn bolstering office space demand. And while office attendance has gradually improved nationally, there's still considerable variance by metro. Miami and New York are closest to a full recovery, while numerous cities like Denver, Boston, San Francisco, and Chicago have been slower to return. That said, San Francisco, despite having one of the highest vacancy rates in the nation, has shown some of the strongest year-over-year improvement in office attendance, highlighting the gathering momentum in that market. Nonetheless, with new office construction expected to reach its lowest level in more than 25 years, the positive, though tepid space demand gains are forecast to reduce office vacancy rates in 2026 to 15.9% by year end. Within this context, office property investment activity has remained well below the pre-pandemic norm. Still, elevated cap rates and unique investment opportunities have attracted a range of investors. Owner users, who historically constituted between 5 and 8% of the buyer pool, now conduct about 13% of the acquisition activity. And private investors, who normally comprise about 30% of the buyer pool, are pursuing opportunistic investments, conducting 53% of the transactions. Average office cap rates have increased by 90 basis points since 2022 to 7.6%. But remember, those are the cap rates on closed transactions, and there's no cap rate on a completely empty building, so take the average cap rate with a grain of salt. At this point, office properties are trading with an enormous price and cap rate range, depending on the specific asset, its location, its tenant base, the in-place leases, the property's performance outlook, and a variety of other variables. That said, there are some very unique investment opportunities for investors who understand the nuances of office assets and who have the financial resources to maximize the property's potential. So, the office sector tailwinds remain modestly positive, but the nuances of each asset in each market will remain a driving factor. Ultimately, the office market still favors seasoned investors who keep their eyes on the horizon.